Good morning there, and thank you very much for having me. My name is Lawrence Bowles. I'm a director in the residential research team at Savills, and it is my pleasure, my delight to spend the next 15 minutes or so talking to you about what on earth has been going on in the UK residential market. We're going to talk transactions, we're going to talk interest rates, we're going to talk tax, and all sorts of other interesting and delightful things. And we're going to start by talking about transactions, though, because that's really where a lot of the spiciest action has been ongoing. This rather intimidating looking chart shows three different measures of transaction activity. We've got all of these measured as a proportion of where they were back in the last normal, or I say inverted quotes, normal times between 2017 and 2019. First of these lines to look at is the sort of greeny, tealy one, agreed sales. There's the number of sales agreed subject to contract. You can see there, just after lockdown ended in the early part of May, we had that stamp duty holiday announcement, and transactions leapt up very rapidly, and we were running at around 50% higher than normal activity levels through most of 2020 and the first part of 2021. That transaction activity has died down a bit if you look at the right-hand side of that chart towards July and August. But even in the absence of the most generous part of the stamp duty holiday, we're still seeing transaction levels around 10% above their normal levels. It shows that there's more than just the stamp duty holiday driving the market. If you look at these other lines, the mortgage approvals line shows you just there's been a bit of a delay in getting those mortgage valuations secured, and just reflects the shape of the market there. But the completed transactions line is the other really interesting one. This really reflects some of those delays that we've seen in the mortgage market, more specifically delays to land searching, to conveyancing and so on. And it also shows the lumpiness that comes into the market as soon as you start putting deadlines on people's stamp duty holiday transactions. We saw a first spike in March when we all thought the stamp duty holiday was going to come to an end, and then a subsequent spike in June when Rishi Sunak did actually taper the scheme down, reducing the maximum saving from £15,000 to just £2,500. We saw transaction activity swing from 94% above normal levels in June to 22% below in July. Clearly a pretty significant swing in activity levels through that point. We've started to see that come back in August, and we do expect to see another strong month of activity in September as we see people trying to beat that last stamp duty holiday deadline as the more limited support comes to an end in that month then. So with all of that in mind, that elevated level of activity, it should come as no surprise that we've seen elevated levels of price growth across the country, with the nationwide recording 10% house price growth in the year to August. But the distribution of that growth has been changing, and it's been changing in a way that sort of reflects a lot of the trends that we were seeing over the long term anyway. If we think back to June 2016, and we think back to 2016-17, then most of the price growth we saw was in London and the South East. We saw the most rapid levels of growth in the east of England, followed by London. If we look further ahead, though, and if we sort of look to the map on the right as we move forward through history, we can see there price growth easing and, in fact, prices falling in London, and the darker red regions, the higher levels of price growth, shifting up through the Midlands and North. And even as we see that resurgence in price growth across the country, the strongest levels of growth are in those more affordable regions across the Midlands and North. In particular, the Northwest, where price growth has been in excess of 18%, and indeed in Wales, where we've seen very fast levels of growth there. We are still seeing growth in London, just to a much lower, much more limited extent than we've seen across the rest of the country, reflecting there the difference in affordability levels in those different regions. And it's not just geography that's defined a split in the housing market. We've also seen a split in access to the market based on how much of a deposit you're able to put down, a split between the housing haves and have-nots. For those who don't have much of a deposit to put down, who are borrowing at higher loan-to-value ratios, well, they've had a tough time. And that's reflected in the average quoted rates that we've received from the Bank of England. The pole vaulter trajectory across the course of the pandemic for those people borrowing with 5 or 10% deposits, leaping rapidly from those pre-pandemic levels where you could get a 10% deposit mortgage for below 2% to those rates almost doubling at their peak through 2020. Those rates are starting to come down now, but there's still significant barriers, significant affordability hurdles for those people trying to access the market with a smaller deposit. On the other side of things, you've got those people with lots of equity to put down, and there we've seen mortgage lenders break record after record after record, offering cheaper rates for those with 40% equity, or generally, long-term low rates for those people who do have the equity to back up their offers. For those people who haven't been able to access the market, or perhaps for those people looking to invest in properties, there we've seen rapid divergence in different parts of the market as well. In cities, we saw rents taking a tandem dive, with rents falling across Birmingham, Manchester, London, Glasgow, Leeds, just about any major city you want to point at. By contrast, rents in the countryside have boomed. And if we look at arguably the most countryside of all local authorities, Cornwall, there we saw rental price growth of 10% in the year to May in those latest Zoopla figures. We do expect this to return to more normal levels. We do expect to see rents in London and other cities to bounce back, particularly as we see things returning to normal, as we see the luster of city life return with the bars, restaurants, shops, pubs, everything else open again. But that's going to take a bit of time for those rents to recover. With all of that demand, supply and balance in mind, you would think that surely developers, house builders must be having an absolute whale of a time. And that's sort of the case in terms of the demand that they've been experiencing, but they've also been wrestling with a whole host of other challenges. Delays to the planning process, with planning committees only able to meet online and then briefly not at all, as we saw that gap in legislation, which meant they could neither meet online or in person for a while. We've seen delays to supply chains. We've seen materials costs ballooning. And as a result of that, housing delivery has been starting to ease, particularly over the last few months. This chart tries to illustrate that. It's showing the same thing in a few different ways. Those yellow bars just showing the number of energy performance certificates registered for new homes. And that orange line and the red line there comparing that period to the same period in 2019. You can see that housing delivery recovered relatively quickly through the course of 2020 as we saw lockdowns easing and house builders learning to work the social distancing on site. And we indeed saw an acceleration of delivery. In the first part of 2021, we saw housing delivery pretty rapidly pretty significantly above normal levels. It's only in the second quarter of 2021, that we have seen those supply chain issues really come to a crunch point, limiting housing delivery and bringing that down to around 10 to 20% below normal levels through June, July and August of this year. So that takes us to where we are at the moment. We've got a market that's been experiencing extremely high levels of price growth, particularly in those markets away from London. We have seen mortgage affordability much more constrained for those with smaller deposits and much easier, much lower rates available for those with a large amount of equity behind them. And a really two-speed rental market with rents starting to bounce back in cities, but still way ahead out in the suburbs and countryside. This chart takes a look at where we expect things to go next. These are the forecasts we've taken from Oxford Economics back in the second half of September. Those show we're expecting to see continued bounce back in economic growth over the course of 2021 and the early parts of 2022, but for growth to return to more normal levels as we move through 2023 and beyond. If we look at unemployment, we see the impacts there of the furlough scheme, capping unemployment at 5.2%. And maintaining it at relatively low levels, easing back down to sort of those more normal 4% levels that we've grown accustomed to, again, over the course of the next few years. The slightly spicier line in all of this, and particularly given we're talking about the mortgage market, is that bottom orange line there, the base rate. Now, these forecasts are taken from the second half of September. They predict the first initial tightening of monetary policy in the tail end of 2023. We've heard from Andrew Bailey, the Bank of England governor, that there may be capacity to tighten those rates a little bit faster than previously anticipated. And that does put us in a position where potentially we see a higher interest rate environment by the end of 2025-26. Still early days, and we wait to see exactly what the pace of the decisions that the Bank of England is going to take there. But broadly, the story from all of this is that while mortgage affordability now is very loose, there's a lot of those rates are very low. As we see the base rate increase over the next few years, we're likely to see affordability become much more constrained, particularly in those markets when leverage is highest, in those markets where people are having to borrow much more. So that's broadly a whistle-stop tour through the UK housing market. And I thought I'd leave you, much like an Olympics closing ceremony, with a glorious fireworks display of facts to take away and mull over through the rest of this webinar. So, of course, as I've said earlier, there is more to the market than a stamp duty holiday. Yes, those tax incentives have incentivized people to get out and move, but we have also seen people getting out there because they are desperate to get into bigger homes because of their experience of lockdown, people reassessing their housing priorities in the light of that experience of the pandemic, and also now increasingly moving back into cities as they feel the need to get back into work, get back into the office more frequently. We're seeing a growing split between those who have housing equity saved up already and those who do not. And the implications there are for what looks like an increasingly two-speed mortgage market. We've got an increasing challenge to face in the context of all of this. Of course, we've got to remember that in the context of all of this, net zero carbon remains a key challenge, and that as we go through COP26 over the next couple of months is going to be at the forefront of developers and lenders' minds. And as we see Help to Buy coming to end over the coming years, that will be an increasing challenge, both for the developers who are building the homes and trying to sell them, but also for the buyers who were previously accessing Help to Buy, getting that cheap finance, that's sort of effectively a cheap second mortgage from government. There we will have to see alternative products come through or alternative routes to market for those house builders to get those homes built and sold. That's it from me for today, everybody. But it's been a pleasure presenting to you all here today, and do enjoy the rest of the webinar. Thank you.